welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri, and thank you for tuning in. This week, as usual, we'll discuss 4 key focus points highlighting key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll take a look at the ISM Services PMI data. In point number 3, we'll talk about the Federal Reserve's economic outlook. And in point number 4, we'll take a look at the U.S. jobs data. Now, on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected negative 2.4% growth for Q1 of 2025 as of March 6th, which is another decline from the 1.8% reported last week. This data incorporates recent ISM data, which we'll discuss in point number 2, U.S. Bureau of Economic Analysis data, and the recent U.S. Census Bureau data. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims fell by approximately 9,000 claims, ending at a bit over 223,000, while continuing claims rose to 1.897 million. From what I can see, this data has not yet reflected recent layoffs from the federal government, and we'll continue to watch this metric closely as we see those changes come into the calculation. Next, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw minimal movement again in the 30-year and 15-year mortgage rates, ending at 6.52% and 5.79% respectively, all moving in the right direction. As I've mentioned previously, there is a correlation between the Federal Reserve's short-term funds rate and mortgage rates. However, it's not direct. As you've seen in the past 2 weeks, we've seen mortgage rates come down, but there hasn't been any drop in short-term rates. We'll spend some time diving into this relationship and the key factors that influence mortgage rates in a future video. For now, just know that mortgage rates are directly related to the 10-year Treasury yields, and there's a lot more to come on that. Next, we'll look at investor sentiment. One component of investor sentiment is the measurement of the bull-to-bear spread. The latest update shows the bull-to-bear spread rose slightly from a negative 41.23% last week to a negative 37.78% this week. Investors are feeling very bearish with the current market. Last week, we hit the lowest mark on this indicator over the past 3 years, with only the slightest improvement in the past week. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 12% probability of a 0.25% decrease and an 88% probability of no decrease in March. As mentioned in last week's video, future meetings projections show greater probability of rate cuts. For example, the May meetings futures are projecting a 5.5% probability of a 0.5% decrease, 46.6% probability of a 0.25% decrease, and a 47.9% probability of no decrease. We'll continue to watch these probabilities and report out to you all as we get more information. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended negative 1.34%. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, was negative 1.24%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the US, was positive 1.29%. International stocks took the win this week. I've highlighted key moments from the past week on your screen. Tuesday, the market reacted to the enactment of the tariffs that were announced by the Trump administration. Thursday, to Jerome Powell's speech, and Friday, to the U.S. jobs report. Remember, these events are not the only drivers of the market, but I wanted to take a moment to highlight the factors that could influence market movement. There are a number of other factors that move stocks and the whole market as a whole, but these are just a few that we discuss every week. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk, while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. Now on to point number 2, the ISM Services PMI. The services sector in the United States experienced expansion in February of 2025, as indicated by the services PMI registering a 53.5%. This marks the 8th consecutive month of growth and the 54th time in 57 months since the recovery of the coronavirus pandemic-induced recession, which began in June of 2020. The Business Activity Index registered 54.4%, the New Orders Index recorded 52.2%, and the Employment Index came in at 53.9%. The Suppliers Deliveries Index registered 53.4% as well, signaling slower supplier delivery performance. 14 of the 17 industries reported growth in February. The 3 industries that reported contraction are management of companies and support services, retail, trade, and educational services. Several indexes showed notable changes in February. The price index rose to 62.6%, reaching its 3rd consecutive month above 60%, a level not seen since March of 2023. The inventories index increased to 50.6%, returning to expansion territory, while the inventory sentiment index expanded to 54.7%. The backlog of orders index also increased to 51.7%, marking its first expansion since July of 2024. Concerns persist among the service sector respondents regarding the potential impact of tariffs and federal spending cuts. Some anticipate that tariffs will disrupt information and pricing, potentially leading to an artificial inflation of purchases followed by a subsequent drop-off. Others expressed uncertainty about future business activity due to the risk of tariffs and potential government actions. Now on to point number 3, the Federal Reserve's economic outlook. This past week, Federal Reserve Chair Jerome Powell addressed economic uncertainty and interest rate policy, noting that the central bank's ability to remain patient in adjusting interest rates due to the uncertain impact of the Trump administration's economic policies. These policies span trade, taxes, government spending, immigration, and regulation. Powell emphasized that the net effects of these changes would influence the economy and the Fed's interest rate decisions. He also acknowledged the high level of uncertainty surrounding these changes, especially in trade policy, and stressed the importance of distinguishing between genuine signals and market noise. Powell's remarks led traders to reduce their expectations for the number of interest rate cuts by the Feds this year, with the Feds expected to remain on hold. Interest rate reductions typically decrease borrowing costs for mortgages, auto loans, credit cards, and business loans. While President Trump has advocated for immediate interest rate drops, Powell highlighted that tariffs usually cause a one-time price increase rather than persistent inflation, potentially allowing the Feds to disregard such temporary effects. However, Powell also noted that the Fed must consider factors beyond temporary effects when deciding on interest rates. A series of tariff hikes or larger increases could have more significant impact. Long-term inflation expectations are critical, and rising short-term expectations due to tariff concerns, even with stable long-term expectations, could influence the Fed's decisions. The Fed previously reduced its key rates when growth weakened due to Trump's tariffs during his first administration. Despite economic uncertainty, Powell described the economy as generally healthy. The jobs report indicated solid gains, although there were signs of slowing consumer spending and heightened uncertainty amongst consumers and businesses. Many economists have also pointed out the potential for tariffs to impact GDP through reduced disposable income and increased business uncertainty. Now on to point number 4, the U.S. jobs data. In February 2025, the U.S. economy added 151,000 jobs, which was below the market expectations of 170,000. The unemployment rate slightly rose to 4.1%. The Bureau of Labor Statistics, or the BLS, data presented a mixed view of the labor market, with some suggesting that the report reflected conditions before recent policy changes took into full effect. The survey period for the jobs report was around February 12th, before the announcement of significant federal job cuts. Several sectors experienced job growth, including healthcare, which added 52,000 jobs, financial services with 21,000 new jobs, and transportation and warehousing, which added 18,000 jobs. However, the federal government employment declined by 10,000 jobs, marking the first decrease since June of 2022. 3,500 of those losses were from the U.S. Postal Service. This decrease was attributed to the Department of Government Efficiency, or DOGE's, efforts to cut the federal workforce. The decline in federal jobs offsets gains from the public sector, resulting in the lowest overall government sector job growth since April of 2024. The Trump administration's policies, including federal layoffs, funding cutbacks, and tariffs, have introduced uncertainty into the economy. While some economists remain cautiously optimistic, others warn of potential negative impacts, such as decreased consumer confidence and concerns about stagflation. The number of people working a part-time job for economic reasons increased to 4.9 million, the highest level seen since the pandemic. Now, we've discussed in previous videos how many economists have expressed concerns about potential tariffs and federal spending cuts to negatively impact the economy. Some businesses as well are hesitant to hire due to the uncertainty surrounding trade policies. Despite these concerns, the market reaction to the jobs report was muted, though stocks were down for the week. The report is viewed as a glimpse of the labor market in transition prior to the full implementation of the Trump administration policies. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of the social media outlets. If you'd like to see our latest video on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you again for watching. We look forward to seeing you next week.